Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Rigetti Computing.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, we'd really appreciate it.
So imagine checking your portfolio on a random Tuesday morning, right? And you see this explosive 80% one-year return on a bleeding edge tech stock.
Oh, the dream scenario. You feel like a total genius.
Exactly. You feel brilliant. But then, you log in maybe a few weeks later only to watch that exact same position plunge over 40% year to date.
Just absolute whiplash.
Complete whiplash. And that is exactly the situation with Rigetti Computing right now.
Yeah.
I mean, we are talking about a high beta, pure play, quantum hardware company.
And for those who don't track market volatility metrics every single day, high beta essentially means this stock is hypersensitive. Like it reacts strongly to broader market swings.
Right. When the market twitches, this stock either jumps to the moon or, well, it dives off a cliff.
Yeah, and right now it's deep in a pretty painful pullback.
It is. So the mission for today is critical for your capital allocation strategy. We really need to cut through the noise and figure out if this aggressive shakeout is, a rare discounted entry point for your long-term risk capital.
Or if the underlying valuation makes this stock a genuine wealth hazard. Because, it is the ultimate dilemma in early-stage tech investing.
It really is.
You have this immense, almost science fiction level theoretical upside, right? And it's colliding head-on with these harsh, near-term financial realities.
Yeah, reality always hits hard. So to figure out if that 40% drop is a track or an opportunity, we have to bridge that gap. We need to look at what their financial statements are telling us today versus the actual technological moat they're building for tomorrow.
Absolutely. And I think we should start by unpacking those hard financial numbers. Because right now, this company is very much in a pre-revenue scale-up phase.
Okay, let's unpack this then. Because for the fourth quarter of fiscal 2025, they brought in $1.9 million in revenue. Now, analyst expectations were sitting at $2.32 million, so they missed.
They did miss. And, earnings per share came in right on the money at -3 cents.
But that top-line revenue miss is glaring. I mean, for a company that is supposedly pitching explosive growth, missing a tiny $2 million target is tough to look at.
It certainly looks glaring if you're evaluating them like a mature, established business. But you really have to view that miss through the lens of their operational timeline.
How do you mean?
Well, traditional earnings metrics can actually be quite deceptive at this specific stage of development.
Yeah.
What you really want to evaluate in a pre-revenue or, early revenue scale-up is visibility.
Right, like how clear is their path to future cash?
Exactly. And their revenue visibility has improved dramatically just since that fourth quarter closed.
I see where you're going with this because in January 2026, they secured a highly publicized contract.
A very big deal for them.
Yeah. An $8.4 million order from India's Center for Development of Advanced Computing, or commonly known as CDC, and this is for a 108-qubit system.
Right. And what's fascinating here is that single contract win caused analysts at Needham to immediately raise their fiscal 2026 revenue estimates. They bumped it from $18.5 million up to $21 million.
But hold on, let me push back on this for a second.
Sure.
If they cannot even hit a $2.3 million immediate quarterly target, why should I, or you as the investor, care about an $8 million promise from an overseas contract that hasn't even been fully realized yet?
That's a fair point.
It just feels a lot like looking at a biotech stock right before a major FDA approval. You know what I mean? They burn cash, they miss their small quarterly targets, and they just promise you a massive payday down the road. Isn't relying on this Indian contract just kicking the can?
I get that skepticism. I really do. But we have to look at the mechanics of how quantum hardware revenue actually functions. It's fundamentally different than, say, a software as a service company.
Right, because software is a subscription model.
Exactly. With software, you scale revenue incrementally. Every new subscriber adds a few dollars to the pile every month. But quantum hardware revenue is inherently lumpy.
Lumpy, I like that word for it.
Yeah, it comes in large, infrequent tranches. You sell a massive system, you get a massive payout. So the CDAC contract is not just a future payday to keep investors hoping.
So what is it then?
It's concrete proof of commercial viability. It transforms those speculative backlog negotiations into recognized sales. And perhaps more importantly, it proves that sovereign entities are actively choosing their specific architecture over the competitors.
Okay, so the architecture itself is the real selling point here.
Precisely.
And that ties directly into what they consider their ultimate competitive advantage, right? Because they aren't just designing these quantum processors on a whiteboard and sending the blueprints away to be built by someone else.
No, they actually own a proprietary fabrication facility.
Which is huge.
It is. And we really need to emphasize why this matters. In the semiconductor and quantum space, owning your own fab is a monumental advantage. It means you control the physical means of production.
Let's break down the mechanics of that for a second. Why does owning the building, the actual manufacturing facility, make such a difference for the progression of the technology?
Think about the alternative. If you're a quantum startup outsourcing your manufacturing to a third-party foundry, you're entirely at their mercy.
Right, you're just waiting in line.
Exactly. You design a chip, you send the design off, and you might wait 6 months for a production slot just to get a single prototype back.
Oh, wow, 6 months just for a prototype.
Yeah. And if there's a flaw in your design, you have to fix it, send it back, and wait another 6 months. But when you own the fab, you control the schedule. You can tweak the recipe overnight.
So it's purely about the speed of iteration. You bypass the waiting line entirely.
Exactly. And we have a real-world example of this paying off for them. Recently, they had a fidelity issue on their Cepheus 1 108Q machine.
Okay, the 108 qubit one?
Right. Because they have their own proprietary fab, they were able to iterate rapidly and fix the physical issue, bringing the machine's fidelity up to 99.5%.
Okay, I want to pause on the word fidelity for a second because it gets thrown around a lot in quantum computing discussions.
It does.
Break that down for me. If a qubit is just a basic unit of quantum information, what does hitting 99.5% fidelity actually mean? Why is that the golden ticket?
Well, qubits are incredibly fragile. Like the slightest interference from temperature changes or electromagnetic fields causes them to lose their quantum state.
Right, which messes up the math.
Exactly. It creates calculation errors. So fidelity is the measure of how reliable those qubits are. If your fidelity is low, your quantum computer is basically just a random noise generator.
Got it.
So hitting 99.5% fidelity means the hardware is stable enough to actually run complex algorithms without crashing into errors. And competitors who outsource their manufacturing, well, they simply cannot pivot and iterate fast enough to solve those physical fidelity bottlenecks.
That vertical integration is a clear wealth-building signal, honestly, because it shows agility.
Absolutely.
And we are seeing them use that agility to build out different revenue streams. Like, they aren't just trying to sell these giant room-sized quantum computers. They have a commercialization strategy around what they call their Novera QPU.
Yes, the Novera.
Which is a smaller 9-qubit quantum processing unit. And they recently sold one to the University of Saskatchewan. It shows a diversified revenue model.
It does, and this is a brilliant bridge strategy. Selling the Novera QPU generates near-term cash flow, yes, but it serves a much larger strategic purpose too.
It's kind of like a car manufacturer giving away their new concept engine to university mechanics, right? You aren't necessarily making a huge profit on the engine itself.
Right, but you're training a whole generation.
Exactly. You're training a generation of mechanics to build applications around your specific parts. So by the time you open the giant factory, everyone already knows how to use your architecture.
That's a perfect analogy. It gets their proprietary technology into the hands of researchers who will write the software and applications optimized specifically for their hardware.
They're basically building an ecosystem.
While they scale up to the enterprise-level systems, exactly.
But wait, owning a proprietary fab, building out ecosystems, rapid prototyping, none of that is cheap.
No, it's incredibly expensive.
So if they are missing early revenue targets, how are they keeping the lights on in a facility that expensive? We have to look at their liquidity.
We do. We need to see if they can survive long enough to recognize those future sales without severely diluting the shareholders.
Because frankly, some of the profitability metrics are terrifying.
Oh, they are.
Their current profit margin is a staggering negative 3,050.4%. I mean, let that sink in. Negative 3,000%.
Yeah, that number certainly jumps off the page. But again, context is everything in deep tech investing. A margin like that simply reflects the immense upfront research and development costs required.
Before the revenue curve has had a chance to steepen.
Exactly. What matters right now is not the profit margin. It's the runway. Do they have the cash to survive until those contracts, like the CDAC order, are fully paid out.
And surprisingly, despite that aggressive cash burn, their balance sheet is an absolute fortress.
It really is.
Based on the trailing 12 months, they're sitting on $44.9 million in total cash against only $7.2 million in debt.
Which is fantastic.
Yeah, their debt-to-equity ratio is basically non-existent at 0.01, and their current ratio is a robust 37.42.
And that current ratio is the key metric here. For those listening, the current ratio measures a company's ability to pay off its short-term liabilities with its short-term assets.
Right.
So a ratio of 37 means they have 37 times the assets needed to cover their immediate debts.
In a high interest rate environment where borrowing money is incredibly expensive, having that kind of liquidity is a superpower.
It guarantees their survival through this critical commercialization phase. They don't have the immediate threat of needing to dilute shareholders by issuing millions of new shares just to keep the fab running.
Yeah, a current ratio over 37 is almost unheard of in mature industries.
Oh, totally. For a deep tech growth play, it shows management capitalized the company exceptionally well for this specific valley of death phase, the period between building the tech and actually selling it at scale.
Here is where it gets really interesting, though. You have this ironclad balance sheet, this incredible runway, but then you look at the valuation risk, the bear case.
Right, the valuation tightrope.
Because the stock is currently trading at 632 times trailing 12-month sales. 632.
It's astronomical.
And TTM, or trailing 12 months, just looks at the past year's revenue. So having a current ratio of 37 is great, but paying 632 times sales?
Yeah.
It feels a bit like buying a winning lottery ticket, but having to pay the actual jackpot price just to hold it in your hand. How do you justify paying that kind of premium as an investor?
Well, you're hitting on the exact reason this stock has been so volatile. A valuation multiple of 632 times sales means the stock is priced for perfection.
Meaning what, exactly?
Meaning the market isn't valuing the company based on the $1.9 million they made last quarter. They're valuing it based on the assumption that quantum computing will revolutionize global industries.
And that this company will be one of the foundational pillars of that revolution.
Exactly. But that premium leaves absolutely zero room for execution errors.
Meaning, if they stumble even slightly, the market will punish them without mercy.
Severely. If there's any delay in delivering that system to India, or if the fidelity on their next-generation processors drops below that 99.5% threshold.
Or if their infrastructure rollout stalls.
Right. The stock will get hammered.
Yeah.
You are paying a premium for a flawless execution timeline.
Which completely explains the wild price action we've seen. We started by talking about the two different markets fighting over this stock. You had the hype cycle, which drove that explosive 80% one-year return.
And then reality set in.
Yep, year to date, we saw that brutal 40.5% drop. The stock corrected sharply, and right now it's sitting around $14.20.
From a technical perspective, that $13.20 mark is crucial. It represents a significant pullback from the highs, but it may be establishing a higher low support level.
Okay, so a floor is forming.
We saw a 5.11% uptick in recent trading sessions. This strongly suggests a bottom fishing phase.
Interesting.
Value-oriented risk capital is looking at this 40% discount and stepping in to buy.
And it's not just retail investors trying to catch a falling knife here either. The institutional money is making serious moves.
Ooh, big moves.
In the fourth quarter of 2025, Raymond James Financial initiated a brand new position. They bought 156,994 shares.
That's roughly $2.4 million deployed right into the teeth of this volatility.
Exactly. Plus, there is a major catalyst on the horizon driving this institutional optimism. The company just announced a commitment of up to $100 million to expand their operations in the United Kingdom.
Which is a massive global play.
Right. They're aiming to deploy a 1,000-plus qubit system within the next 3 to 4 years over there. And there's heavy speculation that this UK move is tied to potential government defense and research contracts.
If we connect this to the bigger picture, the market dynamics start to make a lot of sense. The broader market experienced a sector rotation, which is why deep tech high flyers fell back to earth recently.
Yeah, investors moved cash into safer assets.
Exactly. The market is digesting that valuation premium we just talked about. But while the retail market might be panicking over a 40% drop, the smart money, like Raymond James, isn't looking at next quarter's minor fluctuations.
They're looking further out.
Right, they're positioning for the long-term UK expansion bet.
So what does this all mean for your portfolio? A 40% haircut sounds terrifying on paper, but if institutions are quietly accumulating shares during this exact volatility, are retail investors just being shaken out of their positions right before the real growth story begins?
That is the classic wealth-building dilemma. Extreme volatility is the toll you pay for high beta returns. And analyst sentiment reflects this exact tension right now.
What are the analysts saying?
They're cautious on the current valuation multiple, but their forward-looking price targets remain very bullish. Rosenblatt reiterated a buy rating with a target of $40.
Wow, $40.
B. Riley Securities upgraded them to a buy with a $35 target, and Needham maintained a buy, though they slightly lowered their target to $31.
Still way above current level.
Exactly. The consensus is that the fundamental progress, like the UK expansion and those university sales, outweighs the near-term valuation digestions.
Okay, so the smart money is accumulating, the analysts are projecting serious upside, and the company has the cash to survive. But you can't just buy a stock like this and look away for 3 years.
Definitely not.
You have to monitor the execution. Knowing that institutions are playing the long game, let's map out the specific milestones you need to watch over the next few months to validate this thesis.
The Catalyst calendar is your roadmap here. First up is the Q1 2026 earnings release. This is critical.
What are we looking for there?
You need to see if the revenue miss we saw in Q4 2025 was truly just a minor timing anomaly due to those lumpy contracts we discussed, or if it's the beginning of a sluggish trend in recognizing revenue.
Right, and alongside the financial, you have to watch the technical milestones. We talked about how they fixed the fidelity on the Cepheus 1108Q machine to hit 99.5%.
Yes, a huge milestone.
Investors must watch for ongoing validation of that metric. Like you said, if the qubits aren't stable, the hardware is useless no matter how many sovereign sales you have lined up.
Exactly. And the ultimate test of both their technology and their financials will happen in the second half of 2026.
That's the big one.
That is when we need to see the commercial execution of the $8.4 million CDAC order. That means the actual physical delivery of the system to India and the official revenue recognition on their books.
That single event will basically validate their entire 2026 revenue estimate.
Absolutely.
So bringing this all together into a final investment thesis, the analysis gives us a bullish score of 7 out of 10. It has an asymmetric risk-reward profile, making it a long-term hold with a horizon of 12 to 24 months.
Yes.
But I have to play devil's advocate on that timeline for a second.
Go for it.
If the target horizon is up to 2 years out, and the entire thesis hinges on deliveries happening in the second half of 2026, is there an opportunity cost for you to lock up your capital right now? Or is this $14.20 entry point the literal price of admission for getting into quantum commercialization before it goes mainstream?
This raises an important question about portfolio strategy. Yes, there's always an opportunity cost to locking up capital, but the thesis here is that the recent 40% pullback was the Great Reset.
It wiped out the froth.
It wiped out the speculative froth from the run-up and provided a grounded entry point. This is a vertically integrated quantum pure play. The upside of them successfully commercializing a 1,000 qubit system in the UK is exponential.
Right.
But it requires an investor willing to stomach extreme volatility. It is not a safe, dividend-yielding utility stock. You are buying a piece of the future infrastructure at a discount to its all-time high.
Right. And that leads perfectly to a final thought for you to mull over as you consider your wealth-building strategy in this space. Right now, owning a proprietary fabrication facility is this company's greatest competitive moat.
It is.
It allows them to build and iterate faster than almost anyone else. But fast forward a decade. When quantum computing inevitably moves from experimental, room-sized tech to the foundational infrastructure of the global economy,
It will.
will the ultimate wealth be generated by the hardware builders laying the physical groundwork, or by the software platforms that eventually run on top of them?
It's the classic gold rush question. Do you want to be the one digging for the gold or the one selling the pickaxes and the maps?
Exactly. If you find our talks useful, please consider subscribe, like, and comment underneath. We will see you next time.